It's August. I'm reframing for the Q4. I'm reframing for ownership of fixed income into 2023, and I'm sorry, I'm lost. Where does it fit into a portfolio?
Yeah, Tom, obviously it's been a very tough year, and there's been a lot of questions about whether bonds can deliver that diversification benefit that they have for so many years. But I would argue that you still get capital preservation, and now you're actually getting income in fixed income. So I think there's still a valid reason to have fixed income. Obviously, you need to be pretty strategic about the amount that you have and the type that you have. We like having higher credit quality, and we're moving out in duration as yields move up so that we can capture some of that income stream longer term.
Kathy, where does credit fit in, given the difficulties we could face later this year?
Yeah, we're very cautious on credit, particularly high yield. The spreads moved up, then they came down, they're starting to move up again, but we just don't think high yield is priced to deliver the kinds of returns we'd like to see in a slowing economy and potential recession scenario. So I'd be pretty careful on high yield. Investment grade, we think is okay. We wouldn't take a huge amount of duration risk, but some of the bigger companies with solid balance sheets should be able to deliver. And you can get decent income in investment grade corporates right now, and locking some of that in, and even a 5-year duration is going to give you north of 4%, which is not bad for an income investor.
When you look internationally, Kathy, and you look at some of the projections for the ECB raising rates possibly by 75 basis points next month, how much does that change your outlook more broadly, considering the regime that we've seen and considering how much pain we have seen transpire in the Euro project?
Yeah, our firmest conviction this year is that the yield curve will invert, and that inversion will deepen. And the harder the central banks go in that direction in terms of raising rates to crush inflation, the more likely we are to see that inversion continue. So it doesn't really change the scenario. It actually, I guess, reinforces the idea that if the ECB tightens aggressively into a very weak economy on top of the Fed and all the other central banks, it's really hard to see that we avoid some sort of global recession, and that should mean more and more inversion in yield curve.
So, and that means also the reason why you're more enthusiastic about duration. What does that mean in terms of the likelihood of the credit declines that you expect, not only in the U.S., but also in Europe? I mean, you're talking about being very cautious on high yield. What's the magnitude of the potential losses that you see versus just simply strategically being away from them as you wait for this to play out?
Yeah, it's more of a strategic decision. Obviously, triple Cs, the very lowest credit quality. We're always a little bit cautious on that, but particularly that's a pro-cyclical position, and this is not the time to be in the lowest credit quality. So we think, you could see spreads widen 150 basis points or so in the high yield area, and there's just not a lot of potential reward for the risk that you're taking in that area. Now, investment grade looks a little bit stronger. A lot of these companies have turned out their debt over the long term, so we don't see quite as much risk there. But it's right. Definitely credit is pro-cyclical, and this is not the time to be overweighting credit.
Yeah, I think I agree with that. When I look at the charts, Kathy, I just looked at a vanilla corporate piece, a quality name everybody knows, and I'm sorry, it's had an ugly August. And I look at the Bloomberg total return index, it's now down 14, even 15% from the peak. But what concerns me, Kathy, is in the last week, it's rolled over again to lower price, higher yield. What are the ramifications if that index breaks through let me get the date, John, if it breaks through the June low? I mean, it's stunning.
Yeah, I think what we're reflecting here is this combination of fear of Fed rate hikes and deteriorating economic growth. So if we break that low, I don't know that there's a huge significance to it. I don't think that we're going to see huge amounts of flows in and out based on, levels anymore. Anybody who wanted to exit fixed income or the credit markets has probably done so already at this stage of the game and moved to very short-term treasuries. But it continues to wear on this the total return in portfolios overall. You're not making money in stock, you're not making money in bonds, and I think that people just will tend to want to be in safer and safer assets if we continue to see deterioration.